Oh, hi. Welcome back. Um, so in our last video, we briefly discussed what are the factors that determine the bond's risk. And of course, the greatest risk in lending is the default risk, right? And also, we discussed, uh, three other three other types of risks called, liquidity risk, uh, interest rate risk, uh, or together with interest rate risk, the reinvestment rate risk, and then finally the uh, inflation risk, right? And I said, inflation risk and the interest rate risk are systemic, so uh, they affect basically everything across the board, every company, uh, every bond. Whereas, liquidity risk and the default risks are the borrower specific, right? Now, so the factors, we can, understand those factors better, those risks better by looking into the uh, fundamentals of the company. So we have to look into the uh, ratios, because ratios are the fundamentals of the fundamental analysis, right? Nothing tells, better about the fundamentals of the company than the ratios. And we talked about, briefly looked into this last time. So because the biggest concern is the default risk, right? Uh, the first thing you would look into is the debt management ratios, right? The second one is the liquidity ratios. Now, obviously, how much debt the company has and how well it is handling and managing the debt will be the biggest concern. That's why you look into the debt management ratio. And if you have taken Finance 230 with me in the last semester, or at least know something like Business 210, this would be a very familiar concept. In debt management ratios, out of 5 categories of ratios, right? Uh, in debt management ratios, the most important two are coverage ratio and leverage ratio, right? Coverage ratio is a broad term, and uh, how well the company can cover its interest payment. That's coverage ratio, interest payment, right? Because I was telling you, I told you so many times in Finance 230 or Business 210 that in corporate finance, right? Um, even a very uh, even a company with good capital structure, right, can still default or even go bankrupt if they cannot make the interest payment. Okay. Uh, Also, in that sense, the liquidity ratio is also very important, because the reason that the companies generally um, go bankrupt is not necessarily because they cannot manage their debt in the long term. It's mainly when because they cannot manage their or handle their payments in the short run. And the most important payment is the debt servicing. Debt servicing means paying interest. And the paying interest is short run, uh, short run obligation because for bonds you have to pay interest at least semi-annually. There may be quarterly, bonds that pay, interest quarterly, but at least as long as you can come up with the interest every 6 months, you're okay. So coverage ratio is another name for debt services ratio, but the most basic coverage ratio is called times interest earned ratio, times interest earned. Okay. You may remember that I was using, if it is times interest earned ratio, why is it XIE? You might wonder, right? This, and I've been telling you, this is not X. That's multiplication, multiply, right? Multiplication. How many times? And I've been telling you, how many times? So let me rewrite it here. Times interest earned ratio is basically EBIT over interest. Now think about it. This ratio is actually called cash coverage ratio because it has depreciation in the numerator, right? Not only EBIT, but also depreciation. Now, let's think about it. What is the source of the funds to pay interest from? For any company, the source of the funds to pay interest from is EBIT, right? EBIT, earnings before interest and taxes, right? Also called operating income, right? Operating income. This is actually the reliable first level of profit because and in accounting they say gross profit is the first level of profit. That is, and that, yeah, I understand why they are saying that, but then it is not true stage of profit. It's not the true stage yet. Why? Because there is no such company that doesn't have any OPEX, right? I mean, of course, if you are very theoretically and hypothetically, if your company is really, really lean and mean, then there may not be no operating expenses, right? Only the direct cost and no indirect cost. But that is only a hypothetical example. In reality, there can be no company without operating expenses. Look at even Amazon.com. I mean, Amazon, look at their, in the early days, of .com, like, late 1990s, they all thought .com would drastically cut down on operating expenses because you don't have any permanent, because online shopping can, happen from home. I mean, not from the buyer's end. Don't. I'm not talking about the buyer's end. If you're selling something from something online, you don't even need a warehouse. You don't need a plant. You don't. I mean, if you're just uh, selling retail goods in a retailer, not manufacturer. Manufacturer needs uh, a plant, right? These days, even manufacturers just outsource. Uh, but if you think about it, if you're selling something online, you can start from home, and then you think, oh, then I don't have to have an office. I don't have to rent an office. I have a computer. I have internet connection. I don't need a warehouse. I can use my, room to stock up the inventory. So they thought at the beginning, yeah, and that was an example of minimal operating expense, minimal fixed cost, right? But in reality now, as online business booms, now look at Amazon. Without the warehouse, what? Huh? Without their, giant um, warehouse, what's that called? Big distribution centers, right? Without their big distribution centers, can Amazon even, exist? No, it can't. So, in other words, there's no business that uh, cannot that won't have any fixed costs. So, before subtracting fixed cost, you cannot call that profit. But what is gross profit? Gross profit is the profit uh, subtracting, just the direct cost from the revenue, the result of, subtracting, direct cost, only the direct cost from the revenue. But then, think about it. That cannot be the true profit, right? Of course, the true profit is the net profit or net income or profit after tax, right? Or income after tax, net income after tax, or whatever they call it. So many names, so many words. And that's why, in accounting, they need to really, really clean up the terminology. They really need to clean up the terminology because the same thing is called by so many different things. But the idea is EBIT or operating income is uh, the first stage of true something that can be truly called profit, right? And from EBIT, that's the source of the fund, right? That's the source of the money where the interest payment can come from. So the big question is, if the companies, think about it, if this ratio is not even one, if the ratio is one, what does that mean? The company is barely making enough to pay interest, right? So you don't want this um, number to be one. You want this number to be way greater than one, like 15, 20, 25, 60, right? Uh, the higher this ratio, right, uh, the more money they have to pay out interest. So the more reliable the company is, uh, less likely to uh, default on the interest. So that's literally why it is called, times interest earned, right? How many times? Literally, how many times? What it means is, So how many times what? How many times the interest is the EBIT, right? That's what it means. That makes sense? Okay, and if you solve this equation for how many times, right, then it will become EBIT divided by interest. Make sense? And cash coverage ratio as just, depreciation to the numerator, because if you remember from finance to 30 that depreciation is source of cash. It's unused cash or preserved cash. Okay. Now, fixed assets coverage ratio is basically, because it has, a lease payment, because, lease is, also cash payment, regular cash payment. You need to pay, you have to there's no way you can avoid, paying, lease, right? Just like the rent, right? Lease on, rent is a kind of lease, of course, right? Um, I mean, you pay rent based on the lease agreement, right? But anyway, and then the leverage ratios are, this leverage means, using debt. So leverage ratios, most typically, total debt to total asset ratio, total debt. Yeah, total debt, this is capital structure literally, right? Um, and the capital structure is a very important element you have to look into, because if the capital structure is, and you understand total assets come from what? Only two sources, right? There are no other capital sources, only two sources, equity and debt. Equity and debt, right? So if the proportion of equity is 90%, what does that mean? Debt is 10% of his total assets, right? And then I've been telling you this is something you should remember from corporate finance, FMB 230 finance, that optimal capital structure isn't necessarily 100% equity. Optimal capital structure is found empirically somewhere between 60 to 70% equity. That means 40 to 30% debt. That would be a optimal capital structure. And it's not just empirical, mathematically we can find that point, right? That optimal, and mathematically it comes to in most cases. And what is the mathematically it comes to somewhere between 60 to 70% equity and 40 to 30% debt. And why is it called optimal capital structure? Because at that capital structure, your your stock price is the highest, and your return is the highest. Earnings per share is also the highest. You get the maximum return, maximum return on equity, maximum maximum earnings per share, maximum stock value. Right? That's why it's called, optimal capital structure. So debt ratio is not difficult to find, but obviously, as the debt ratio goes up, uh, it's it's not favorable for the rating, right? Uh, Too high debt ratio, right? Let's say debt is about 60%, 70% of the company. Of course, that will uh, adversely affect uh, the bond rating because the default risk is going up, right? And debt to equity ratio, when we say debt to equity ratio, actually it doesn't include uh, short-term debt. Short-term debt means current liabilities. It only includes long-term debt. In other words, non-current liabilities. Because when we say capital, actually capital refers to long-term capital, like long-term debt and equity. Uh, Capital doesn't refer to the short-term liabilities or current liabilities, right? So debt to equity ratio is, basically a ratio between long-term debt and um, equity. So here's the thing: if the capital structure is debt to equity, if the total debt ratio is 30%, what does that mean? That means 30 out of 100% of total assets, 30% is uh, debt, which includes both short term and long term. And that means 70% is equity, right? Um, but then so you might think, oh, then debt to equity ratio must be at 30 over 70, 3 over 7. No, no. Uh, what if, as I said, it only counts long-term debt. So out of this 30, if short-term is 10, long-term debt is 20. Okay, out of this 30%, 20% is if you divvy up 30, by that ratio, actually, you understand what I'm talking about. They both have to add up to 100, right? And that 100 is this 30. But ignore that. Out of this 30, if it is 30 billion dollars, that means 20 billion dollars is long-term debt, right? Uh, then debt to equity ratio in this case is 2 to 7 or 2 over 7, right? Okay. Now, next is the liquidity ratios. You remember, there are 5 categories in the ratios, First of all, profitability ratios, right? Like return on assets, return on equity. Um, Second, liquidity ratios, right? And asset management ratios, such as, inventory turnover ratio, fixed assets turnover ratio, and debt management ratio, right? Like coverage ratios, leverage ratios, and market valuation or stock valuation ratios, such as price earnings ratio, price to market price to book value ratios, right? Now, liquidity ratios are, how much, liquidity the company has, or basically, how much, cash flow the company has. There are 2 major ratios, current ratio, which is current assets over current liabilities, quick ratio, which is, current assets except inventory over divided by current liabilities. Now, these liquidity ratios, debt management ratios, and liquidity ratios come on top because they directly affect the ability to pay debt, ability to service debt, interest, or ability to pay short-term payments, short-term obligations. In other words, liquidity ratios basically tell you whether you can meet your payment obligations, such as payment uh, accounts payable, wages, right? Um, Notes payable, right? And also short-term accrued taxes and things like that, right? So I've been telling you that a company can go bankrupt not because of its long-term debt issue, but short-term payment obligations. That's why we need uh, coverage ratio and liquidity ratios, right? And then profitability ratio is very fundamental because a company has to be profitable anyway in the long run, even in the short run, right? A company has to be profitable. If a company is not profitable, then the business is not viable. And the profitability ratios are measured by return on assets and return on equity. And there is also a ratio such as cash flow to debt ratio. At least current cash flow, can it cover how much of debt is it? I mean, is it bigger? Usually, current cash flow would be this ratio, uh, maybe less than one in general, right? But what's important is, how do you know if the company meets, the threshold? Uh, there are some ratios that have no fundamental threshold, such as current ratio and quick ratio. Current ratio, the threshold is 2. It has to be greater than 2. Quick ratio, it has to be greater than 1. Excuse me. But other ratios, you have to compare it with the industry average. Industry average, right? If your ratios are better than industry average, you're good, right? If your ratios are not better than industry average, higher than industry average, you are in trouble. Now, that means you're lagging behind, average of your industry, average company of your industry. Now, once you check out these ratios, and once you know about those ratios, there are so many things to do, and we don't have much time. Now, this is the sample sample ratios from bond ratings. Uh, Look at this. What does this mean? EBIT interest coverage multiple. What does that mean? That means exactly times interest earned. In other words, I've been telling, as I said, they use so many different terminologies, for the same thing. So your mind should be really, it's not flexible, but not flexible like crazy, wild, freewheeling, mind, but it has to be anchored on a firm foundation, and you should be able to interpret the same thing in many different ways. Now, think about it. EBIT interest coverage multiple means what? Multiple means how many times? Multiple means, if my let's say car has 3 times more value than my old car, if my current car has 3 times more value than my old car, what does that mean? My current car value is 3 times multiplied my old car value. Isn't it right? If you multiply 3 to, my old car value by 3, that gets me. So 3 is the multiplier, and my current car value is 3 times the multiple of my old car value. This is all a matter of, logical thinking, right? If you think logically, you can interpret it. And a lot of people are just, very weak in critical thinking or logical reasoning, and then, only touch the surface, and they cannot go deep into its, essence. The essence of this expression is exactly how many times the interest is the EBIT, right? How many times the interest is the company's EBIT, right? So it's times interest earned ratio, right? Uh, how many times can interest cover? How many times the EBIT can cover the interest? So it's exactly times interest earned ratio. And then think about it. If you look at if you look at AAA companies, their earnings, EBIT, or operating income, is almost 24 times their interest payment, right? That's how. But look at the, at least double B, triple B is the bottom line of investment grade, almost 5 times more than interest payment, right? But look at the triple C. Triple C has, they may have already bankrupt, but recovery possible, something like that. And their operating income is not even, equal to their interest payment. But such a company must have already defaulted, right? Logically, isn't it right? If their earnings are not even enough to cover interest, then they must have defaulted already. Now, EBITDA is earning, DA is depreciation and amortization. So it will give you, remember, depreciation is preserved cash. Amortization and depreciation would normally, cancel out each other. But if not, depreciation would still give you more preserved cash to EBIT. So it's slightly more cash flow than, EBIT. So look, after it, times interest earned using EBITDA is, for AAA companies, almost 26. Funds from operations over total debt. That's literally free. Now this one is a little weird. Little weird, terminology, because it's either free cash flow or operating cash flow. But never mind, I will assume, let's say, if it is free cash flow, and free cash flow is defined, very strictly. Just because it is free, it's not liberally defined, but think about it. Operating cash flow is something similar to EBIT, but the difference is, depreciation and depreciation is added to EBIT. So you might say, isn't it EBIT? No, slightly different. We're running out of time, so I'm gonna get to that in the next video. But think about it. This is, cash flow to debt ratio, and like right? Remember, cash flow to debt ratio, total cash flow over outstanding debt. Uh, so 127. That sounds very good, right? But look at triple C companies. It's hopeless, right? Um, total debt over EBITDA multiple. So how many times the EBIT is the total debt? Of course, because uh, if you have this much, I mean, if you flip it over, think about it. If this ratio is 0.4, that means total debt is 40% of um, EBITDA. What kind of that's great. This company has so little debt or so much operating expense. Um, if you flip this number, what does that mean? Um, that means exactly almost they have almost 2 times the total earnings before interest and taxes. That is greater than interest by greater than total debt by more than 2 times. Return on capital, it's different. Return on capital is uh, net profit divided by uh, total capital. And I told you total capital is not different from total assets in the sense that capital means only long-term debt and equity. Now, this is total debt over total assets ratio. In other words, exactly debt ratio. And if the total debt, both long-term and short-term debt, current liabilities and both, current liability, non-current liabilities are 12.4% of the total assets. What does that mean? Equity is 87.6%. That's how solid the capital structure of AAA companies. Okay, alrighty. So I'll have to uh, stop the video and see you guys in the next video.